Hedge Fund Market Wizards by Jack D. Schwager. Picture this. It's the 1950s, and a young math professor walks into a Las Vegas casino with his wife and $10 silver jingling in his pocket. Edward Thorpe knows the house always wins. Every mathematician does. But he's heard whispers about a new blackjack strategy that might just level the playing field. Why not give it a shot? 20 minutes later, he's down to $2 silver. Now, most of us would have chalked it up to a lesson learned and headed for the buffet. But Thorpe? His brain was already racing. He realized something fascinating. While the odds stay fixed for a full deck, they shift with every single card that hits the table. What if you could track those shifts? What if you could spot the exact moment when luck tilted, even just a hair in your favor? This question became an obsession. Thorpe spent thousands of hours crunching numbers, first on a clunky desk calculator, then on one of MIT's room-sized IBM computers. He did what casinos swore couldn't be done. He cracked the mathematical code to beat blackjack. His book, Beat the Dealer, sent shockwaves through Vegas. Casinos literally rewrote their rules because of him. But here's where it gets wild. Thorpe and his buddy Claude Shannon, yes, that Claude Shannon, the father of information theory, built the world's first wearable computer. A tiny device hidden in a shoe that could predict roulette outcomes, giving them a mind-blowing 44% edge over the house. Yet even that wasn't enough for Thorpe. He looked around and realized there was a casino infinitely bigger than any Vegas strip, Wall Street. So he turned his genius loose on the markets and didn't just succeed. He demolished the cherished academic belief that no one can consistently beat the market. For decades, an elite tribe of traders like Ed Thorpe have been quietly achieving what everyone said was impossible. They're called the Market Wizards. And one man, Jack D. Schwager, has made it his mission to track them down, sit across from them, and convince them to spill their secrets. Hedge Fund Market Wizards isn't just a bunch of interviews. It's a backstage pass to a hidden world of unimaginable wealth and crushing pressure. Schwager's work has inspired a generation of the world's best investors and sold millions of copies because the lessons inside never expire. Today, we're not just talking about stocks and bonds. We're decoding the winner's mindset. We'll uncover the rules these masters live by, the catastrophic mistakes that nearly destroyed them, and the profound principles you can apply to any high-stakes game in life. By the end, you'll understand that the secret to winning isn't about predicting the future, it's about mastering yourself. Let's kick things off by destroying a myth that trips up almost everyone. The idea that somewhere out there exists a magic formula, a holy grail that'll unlock the markets and guarantee success. Schwager makes this crystal clear. If you're hunting for an easy formula, you're hunting in the wrong forest. The first lesson from the Wizards? There is no holy grail. There's no single right way to trade. In fact, the traders in this book use methods so wildly different, they sometimes look like complete opposites. Take Cole Moshe, a global macro trader who thinks like a historian mixed with a diplomat. He studies the grand sweep of economies to make huge bets on currencies and entire nations. His journey didn't start in some finance classroom. It began in a dusty Roman market, where the only English book he could find was a beat-up copy of Reminiscences of a Stock Operator. That book showed him trading wasn't about numbers on a screen. It was about reading the world's story as it unfolded. Then there's Geoffrey Woodruff, who couldn't be more different. Woodruff is a quant, a data wizard. As a kid, he wasn't reading market psychology. He was obsessively rolling dice to understand probability, then programming early computers to roll them faster. When he tackled the markets, he rejected the two main approaches. trend following, and mean reversion. Why? Because his contrarian soul couldn't stomach being part of any herd. So he locked himself in a university computer lab, fueled by nothing but Pepsi, and worked nearly 40 hours straight searching for a third way. He emerged with a system that hunts for complex patterns no one else was looking for, a method entirely his own. You've got the storyteller O'Shea and the mathematician Woodruff, value investors like Joel Greenblatt hunting for bargain businesses, tape readers like Jimmy Bulladimus, who feel the market's rhythm second by second, using almost no fundamentals at all. Each found their own path. As O'Shea puts it, "If I try to teach you what I do, you will fail because you are not me." You've got to find a method that fits your personality, like a custom suit. A strategy that makes one person rich can bankrupt another if it clashes with how their mind works. The journey isn't about finding the perfect system. It's about finding the system that's perfect for you. Once you start that journey, you quickly learn the most paradoxical truth. The very best traders aren't obsessed with making money. They're obsessed with not losing it. This brings us to the art of losing. The wizard's real secret isn't genius at picking winners. It's genius at managing risk. Let me tell you about Larry Benedict. His early career was, bluntly, a train wreck. He got fired from his first job as a clerk. Then he became a trader and blew through his entire account. The firm gave him another shot with fresh capital, and he lost most of that too. A friend staked him again, and he lost money so fast, his friend pulled the plug before he even hit his loss limit. By any measure, Benedict should have quit. He had zero evidence of skill. But he didn't quit. Eventually, something clicked. He went on to post 20 consecutive profitable years, becoming one of the most consistent traders in the business. What changed? He learned that risk management dominates everything. For Benedict, it's not about potential gains. It's about limiting losses. His rules are strict as steel. If his fund loses just 2.5% in any month, he does something that would terrify most managers. He liquidates everything. The next day, he starts fresh, trading small until he's profitable again. Because of this discipline, his worst month in over a decade was just a 3.5% loss. He knows if he manages the risk, profits take care of themselves. This obsession with controlling downside echoes through nearly every wizard story. Michael Platt, who co-founded Bluecrest, one of the world's largest hedge funds, runs an even more dramatic system. When he hires a trader, he gives them capital and one iron rule. Lose 3% at any point during the year, and you're done. Your book gets liquidated. Your year is over. No second chances. This creates what Platt calls a right-skewed return profile. Losses are capped, but gains are unlimited. But just having a stop-loss isn't enough. Plenty of traders use them and still fail. O'Shea reveals why. Most people set stops based on their pain threshold. They can't stomach losing more than $1,000, so they put their stop there. Problem is, the market doesn't care about your feelings. A meaningless wiggle can hit your stop, kick you out of a good trade. Then the market goes exactly where you predicted. Worse, you still believe in the idea, so you jump back in, only to get stopped out again. Death by 1,000 cuts. O'Shea teaches a different approach. First, ask, at what price would my original idea be proven wrong? Maybe the stock breaking below major support would kill your thesis. That's where your stop goes. Only after you identify that price do you decide position size. If the potential loss is too big to stomach, you don't move the stop closer. You reduce your position until the loss becomes comfortable. This way, getting stopped out isn't painful. It's informative. The market's simply telling you that you were wrong. No emotion, no desire to jump back in. You were wrong. you accept it, you move on. This visceral understanding of risk often comes from a painful moment. Ray Dalio, founder of Bridgewater, the largest hedge fund on earth, calls it the electric shock. Early in his career, he went long pork bellies. The market turned against him and went limit down day after day, prices dropping so fast that trading halted. He was hemorrhaging money with no way out, no idea when it would end. That feeling of helplessness taught him a lesson he'd never forget. Risk control is paramount. He says, "I never wanted to experience that pain again." That pain became a gift, which leads us to the incredible power of mistakes. While most people see mistakes as shameful, something to hide, the wizards see them as their most valuable asset. Ray Dalio might be the ultimate example. He's been called the man who loves mistakes. At Bridgewater, he's built an entire culture around radical transparency. Nearly all meetings are recorded and available for anyone to review. People are encouraged to challenge each other, even superiors, openly and honestly. The goal is truth, and Dalio believes the only path there is putting every idea under the microscope, especially the failures. He says there is an incredible beauty to mistakes because embedded in each mistake is a puzzle and a gem that I could get if I solved it. A mistake isn't a failure. It's a signal that something in your thinking is off. If you have the humility to analyze it, find the root cause, and create a new principle to prevent repetition, you don't just recover, you evolve. You get stronger. Larry Benedict's years of failure weren't wasted. They were his education. He says, "The lessons I learned from those early failures helped me become successful." They taught him what not to do, often more valuable than knowing what to do. Steve Clark was handed a trading book for the first time on October 19, 1987, the day of the biggest stock market crash in modern history. He walked in 100% long stocks, baptism by fire. That searing experience burned a lesson into him forever. Anything can happen. The key isn't avoiding mistakes. You can't. The key is learning from them. Clark tells his traders a simple mantra: do more of what works and less of what doesn't. Sounds obvious, right? But it requires ruthless self-awareness. You've got to be a detective of your own performance. Analyze your trades and ask, where do my profits really come from? What setups, what conditions, what mindsets produce my best work? And where do I consistently bleed money? Often, traders nail one strategy but give back all their gains dabbling in other things out of boredom or ego. The discipline to identify your strengths and stick to them while cutting out weaknesses is transformative. This constant self-correction requires another essential quality: flexibility. The market you mastered yesterday might not exist tomorrow. That's our fourth theme, the necessity of adaptation. A strategy that works for years can suddenly stop working. Why? As O'Shea says, the world changed. Markets aren't static. They're living, breathing ecosystems constantly evolving. New technologies, regulations, and global dynamics keep shifting the landscape. A trader clinging to rigid rules because they used to work is destined to fail. Great traders are adaptation masters. They have core principles, yes, but their tactics are fluid. Consider O'Shea's 2009 performance. In April, coming out of the financial crisis, he was deeply pessimistic about the global economy. His analysis screamed trouble. But markets started rising. Asian stocks rallied. Commodities firmed up. The price action contradicted his entire worldview. A lesser trader would have stubbornly held bearish positions, insisting, the market is wrong. But O'Shea had the flexibility to say, the market is telling me I'm wrong. He didn't fight the evidence. He sat back, formulated a new hypothesis. Maybe the world was on the verge of an Asia-led recovery, and completely reversed his stance. He went from bearish to bullish, and turned what could have been a disaster into a profitable year. That's flexibility in action. Sometimes adaptation goes even deeper. Jimmy Baladimus made his name as an aggressive short seller, fading rallies. But over years, he noticed a change. The rise of hedge funds and high-frequency trading made trends more persistent. Rallies that used to fizzle now lasted longer. His old method of stepping in front of every move became dangerous. He had to adapt. He didn't abandon his style, but he became more selective, less aggressive, more willing to admit when a trend had real legs. Edward Thorpe offers another classic example. His first statistical arbitrage system worked brilliantly. But, as competitors entered the space, returns declined. So he innovated, adding layers to make it, quote, sector neutral, improving performance. When that lost its edge, he adapted again with a more sophisticated, factor-neutral model. He was in a constant research war, always staying one step ahead. A good trader builds a boat for today's weather. A great trader builds one that can be refitted for tomorrow's storms. This ability to adapt often pairs with a particular worldview, a tendency to question prevailing wisdom, which brings us to the power of the contrarian mindset. Many top traders naturally go against the crowd. They're suspicious of consensus. When everyone agrees, their alarm bells ring. Jimmy Baladimus lives by this. Smart guys always sell when the market is going up. He's made a career of what he calls stepping in front of freight trains, selling into powerful rallies, and buying into terrifying declines. His logic? Markets are driven by emotion, and crowds are notoriously emotional. They get too euphoric at tops and too panicked at bottoms. The greatest opportunities lie in betting against that irrationality. In early 2011, silver went on a parabolic run, inflation news everywhere, everyone talking precious metals. Baladimus saw this and thought, they're pushing this story really hard. Feels like everybody's buying silver. That's the opportunity I look for. While the crowd piled in, he quietly built a short position. When the bubble popped, he made a fortune. This isn't just about short-term moves. It can be massive, long-term macro calls against the entire world. Martin Taylor's Russia story is perfect. In 1997, as Asian crisis unfolded, investors desperately sought new places for their money. Wall Street brokers hyped Russia as a post-communist miracle. Money poured in. The stock market more than tripled. Consensus was overwhelmingly bullish. But Taylor, managing an Eastern European fund, looked at fundamentals and saw something else. A country living beyond its means, with massive capital flight and ballooning deficits. A house of cards. Russia made up 40% of his benchmark index. Betting against it was career suicide. But his conviction was absolute. He sold every Russian stock, taking his allocation to zero. Clients and colleagues thought he'd lost his mind, but he stood firm. He saw a moment coming when the market realizes the emperor has no clothes. In August 1998, that moment arrived. Russia defaulted, the currency collapsed, the stock market was wiped out. Taylor's contrarian call saved his fund from disaster. Being contrarian doesn't mean always doing the opposite. It means thinking for yourself, developing your own thesis, and having the courage to stick with it, even if it means standing alone. But having a great idea is only half the battle. This leads to our final theme. The edge is often in the implementation, not just the idea. How you structure, execute, and manage a trade can be more important than the initial insight. Back to Col Moshe. After the dot-com bubble burst in March 2000, his big idea was simple: bearish on stocks. The obvious trade? Short the Nasdaq. But O'Shea knew bear markets are treacherous. They have vicious rallies that destroy short sellers. Summer 2000, the Nasdaq, mid-crash, suddenly rallied 40%. Had O'Shea shorted the index, he almost certainly would have been stopped out for massive losses. But he didn't short the index. He looked for a smarter way to express his bearish view. He reasoned a stock crash would lead to economic slowdown, forcing the Fed to lower rates. Lower rates mean higher bond prices, so instead of shorting stocks, he bought bonds. He traded the consequence of his idea, not the idea itself. While the Nasdaq swung wildly, the bond market enjoyed a smooth uptrend. Same idea, but a far superior implementation. This search for the best expression of a trade is a wizard hallmark. Jamie Mai of Cornwall Capital is a master. His entire philosophy centers on finding asymmetry trades where potential upside is many times greater than potential downside. His most famous trade? His bet against subprime mortgages before 2008. His idea? The housing bubble was unsustainable and mortgage-backed securities built on it were junk. But instead of shorting housing directly, difficult and expensive, he found a much more asymmetric play. He bought very cheap, out-of-the-money options, credit default swaps on the lowest-rated mortgage bond tranches. Because rating agencies considered these so safe, the insurance was dirt cheap. He was risking pennies to potentially make dollars. His risk was strictly defined and tiny. But if he was right, and housing collapsed, potential profits were astronomical. When crisis hit, he tells of positions marked at $50,000 on Friday that he sold for $4.5 million the following Monday. That's the power of asymmetry. Brilliant idea, but his true genius was finding the most leveraged, lowest risk way to implement it. This concept of structuring trades with built-in edges goes back to our first wizard, Edward Thorp. When he discovered stock warrants were often mispriced, he didn't just buy cheap ones. That would have exposed him to overall market risk. Instead, he created a market-neutral position. He'd buy the underpriced warrant and simultaneously short the underlying stock. The result? A position with minimal market exposure, but a statistical edge he could profit from as the mispricing corrected over time. He isolated the inefficiency. So what do these stories tell us? Greatness in trading isn't a single skill. It's a combination of many. The analytical rigor to develop a thesis. The contrarian courage to stand by it. The flexibility to abandon it when evidence changes. The humility to learn from mistakes. The obsessive discipline to manage risk above all else. These aren't just trading principles. They're principles for navigating uncertainty, making smart decisions under pressure, and continuously improving no matter your field. The wizards have mastered the market, but their real victory is mastery of themselves. As we step back and look at these incredible traders' lives, what's the single biggest lesson we can take away? I think it's this. The secret to winning in markets isn't a financial secret at all. It's a human one. The market is often described as a complex machine, a system of numbers and charts and economic data, but that's not what it is. At its core, the market is a reflection of human nature. It's a global arena where millions of people's hopes, fears, and beliefs collide every second. Because it's driven by people, it's subject to all the classic human follies: greed, panic, herd behavior, and wishful thinking. The wizards aren't wizards because they have crystal balls. They're wizards because they've achieved a deep, practical understanding of human psychology, starting with their own. They've learned to manage their emotions, remain rational when everyone else is losing their minds. and recognize and exploit the predictable mistakes others make. This is why their lessons are valuable even if you never plan to buy a single stock. The skills they've mastered are life skills. Think about it. We all make decisions under uncertainty. We all have to manage our emotional capital. We all face setbacks and must learn from mistakes. The principles these traders live by can apply to almost any challenge you'll face. So how can you start applying these ideas today, right now? Let me suggest 3 simple practices. First, start a mistake journal, the Ray Dalio method. Next time you make a mistake, on a test, in a conversation, playing a sport, don't brush it off. Take a few minutes to write exactly what happened, why you think it happened, and what principle you can learn to avoid repeating it. This simple reflection turns every failure into a stepping stone for success. It builds self-awareness, the foundation of all mastery. Second, practice thinking in probabilities, the Edward Thorpe and Jamie Mai method. Before any significant decision, ask 3 questions. What's the best possible outcome? What's the worst? What's most likely? By consciously thinking about the range of possibilities instead of just hoping for the best, you train your mind to be realistic, see risks clearly, and make smarter choices. You start seeing life not as certainties, but as a game of odds you can learn to tilt in your favor. Third, actively question consensus, the contrarian mindset. When all your friends love the same movie, listen to the same music, or believe the same thing, take a moment to genuinely explore the opposite argument. Build the strongest case for the other side. This isn't about being disagreeable. It's about training independent thinking. It protects you from herd mentality and opens you to opportunities the crowd always misses. The market wizards are rare, but the qualities that make them successful, discipline, humility, resilience, and endless curiosity, aren't magical gifts. They're skills. They're muscles that can be trained. The market was their gym, but the principles they practiced are universal. They teach us that the ultimate investment isn't in stocks or bonds, but in the relentless, lifelong project of understanding and improving ourselves. That was a summary of Hedge Fund Market Wizards by Jack Schwager. We've covered a lot of ground today, touching on core principles that have guided some of history's most successful investors. But I'll be honest, a summary can only ever be a map. The real treasure comes when you make the journey yourself. The true magic happens in those quiet reading moments when a particular story or simple phrase from one of these wizards connects with you in an unexpected way. This summary is designed to help you decide if this book deserves your time and attention. If anything we've talked about today sparked your curiosity or resonated with a part of you longing to understand the game of life better, then grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change how you see yourself and the world of possibilities around you. The link to the book is in the description below. Also, if you found this journey valuable, please hit that like button and subscribe to the channel. It tells us we're on the right track and ensures you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Thank you for joining me. Let's keep growing together.